Thank you all for coming this morning. It is my great pleasure to be up here with Joe. He doesn't know it, but actually after I joined the FT, I no longer had any interest in going to London, so I had him move back to New York so I wouldn't have to go to London and deal with my head office. This is such an interesting time. You know, 2 months ago, I would have asked you a very different set of questions that I would ask you today, because we've seen the Fed do an incredible U-turn, and most people believe that there's more likelihood of easing from the Fed than tightening from the Fed. From your point of view, is that a good thing, both for the markets and for your business?
Thanks, Henny. Well, I think the Fed is responding simply to the data it's seeing, and I guess the economy isn't quite as strong as the market had presumed. And so I don't think the Fed is necessarily trying to accommodate markets. I think the Fed is responding to a relative lack of strength in the underlying economy. So that's not a great thing for the global economy if the U.S. economy is weaker than everybody anticipates. I'd say in our own portfolio companies, we see the U.S. economy as relatively strong, but there's certainly been a slowdown in the growth rates. I think because rates are starting from such a low level, the policy maneuverability is pretty low for the Fed. And so I don't know if a decrease in interest rates is going to do that much from here. I think that's a bit of the issue if we do find ourselves in another recession.
You know, journalists are always glasses half empty kind of people, and it reflects our own industry, no doubt. But I was looking at some data recently about share buybacks by companies in the States.
Yeah.
And the question arises, if the economy is still growing and it is relatively robust, why are companies engaging in such massive share buybacks, $800 billion expected for this year, and not engaging more in investing in their own business?
Yeah, I think CEOs and boards have to allocate capital. And what they're saying is an allocation of $1 to buy back stock is better than $1 to invest in productive capacity. And why is that? One, it's an outlook on the economy. So if you don't have a lot of optimism about demand for your products, you're probably not going to increase capacity. There had been excess capacity in the economy. Obviously, there's still slack. And then the other problem is that the central banks globally had engineered a zero cost of capital. So to borrow money at 1-2% if you're an investment grade company, the EPS accretion of buying back stock is really significant. It's profound. So I think the Fed is engineered, or central banks globally has engineered, perhaps unintentionally, a misallocation of capital in the corporate sector, which has driven stock buybacks and the use of leverage to do that, and maybe to do M&A at prices that are too high, and misallocation of capital by the investment world, by the pension plans and sovereign wealth funds, where you have to increasingly increase your risk profile to generate the returns you need to meet the obligations you have to the beneficiaries. And so that is a big risk, of course, is that this begins to unwind. But no one is certain how that could possibly happen. And Japan is out there as an example of a country that has had zero cost of capital for a long time. But we might point out the Nikkei is not the best performing stock index over the last 25 years, and the Japanese economy is not the model of growth that the US and the European Union would like to follow.
And yet the prices of every security in Japan have been totally artificially priced because of Bank of Japan policies, and then of course you have all the big powerhouses, GPIF, the government pension fund, and postal savings, all coming in.
Correct.
So, and yet you've just opened an office in Japan. You're looking to do a lot of deals in Japan?
I think it has less to do with the macro environment in Japan and more to do with the fact that there's a great industrial base. I've said to our investors, Japan reminds me of Germany circa 2001 at the beginning of the single currency union, where there's great industrial footprint, inefficient ownership structures, management that had been less focused on shareholder value creation and return on employed capital, great export-led companies with lots of embedded technology. And we see the same thing in Japan, and we're assuming we're in the first or second inning of the corporate restructuring of the Japanese economy, and private equity has a very important role to play in that market. So I don't know how it'll develop, but we're certainly not late getting there, as we weren't in Europe. I mean, we were a relative latecomer to Europe. We showed up in 2000, and the party hadn't really yet started for high-quality private equity investing.
I'm going to go back to Japan and other geographies, but before we leave the issue of the Fed and possible misalignment and misallocation of capital, I just want to read you one data point and tell me what you make of it and how it impacts your business. And that's this. I'm going to read this from a research report from Hong Kong, where I'm from. So corporates have been by far the biggest buyer of shares since the bull market began in 2009. U.S. non-financial companies' net buying of corporate equities has totaled $3.7 trillion in the last 10 years, whereas net buying by mutual funds and ETFs is almost exactly half of that, $1.7 trillion. What do you make of that huge activity by corporate America in the stock market as opposed to in their own businesses?
Well, I think there was a moment when that was a really rational capital allocation decision coming out of the financial crisis, when shares were beaten up and everybody presumed the world was going to end. Now, I don't know how much of that $3.7 trillion was deployed between 2009 and 2012. Probably not a lot of it, because corporates tend to be pro-cyclical allocators of capital. It just means, I think it illustrates the point I was making of corporates not having enough confidence in the underlying economy and aggregate demand to invest in productive capacity, and using zero cost of funds and a very low cost of capital to repurchase shares in a way that was accretive to the accounting earnings per share calculation. It's driven a lot of the EPS growth, which is what most in fundamental value investors focus on. It's driven a lot of the EPS growth in the market over the last decade.
So what are the implications for your business, Joe? Is this a better time to buy or to sell? And how has your thinking changed since we've seen the U-turn from the Fed, which suggests that whenever the market plays chicken with the Fed, the market tends to win?
Yeah, I mean, historically there have tended to be liquidity cycles and valuation cycles, and we tend to exit when valuations are relatively high, or at least at historical averages, and when there's adequate liquidity. So we've been selling in roughly equal amounts, our portfolio companies, starting in 2013 through to today, and we will continue to sell when we've completed the mission with each of the companies that we've bought. Every time we buy a company, we have a specific set of operating intervention plans that we're going to execute. When we do that, if the markets are open, we try to be as disciplined in exiting the portfolio as we are in buying. And so when we've declared victory on the mission, we have a good company, it's saleable, the markets are open, we tend to do that. And we're not trying to make a call, oh, the stocks are high or stocks are low. You know when you can't sell because there's no liquidity. It's hard to know when you're at a top. I thought the top could have been 2 or 3 years ago. Obviously it wasn't. And we've continued to buy, thankfully, through those 2 to 3 years. In terms of the buy side, what we're trying to do is buy companies that have decent market positions where we can do something to improve the business. So we're not totally reliant on the in price, the going in purchase price multiple as the driver of return in our deal. We're looking for the unlevered free cash flow generation over a decade through just regular way GDP growth and the actions we can take to improve the business. That is our true north in valuation. It has less to do with I'm paying 10 and I'm going to speculate that I can sell at 12.
Let's talk about the credit markets briefly. A lot of people in Asia are concerned that the Fed may actually lose control of interest rates, that budget deficits are going to be much higher, that the three largest international purchasers of treasuries are not going to be as supportive. You know, the Chinese are already saying, why are we investing in US treasuries when Trump demonizes us so much and wants to sort of divide capital flows into a bipolar world, not one world. The Japanese are going to have less money to invest. Their current account surplus is going down. And the Saudis do have less money. Is there a danger that rates will go higher? Do you think the markets are aware of that? And might we have this combination of higher interest rates and yet a weaker dollar?
Yes, is the answer. I think there's $9 trillion of treasuries, longer dated treasury bonds in the hands of non-dollar denominated buyers. And if the dollar were to weaken and you're sitting there as a yen denominated holder of treasuries and the dollar weakens, what rate do you need to compensate you for the decline in the dollar? Well, it's probably more than 2.8% or whatever on the 10-year treasury. So I think there is a real risk that non-dollar buyers require a higher rate of return on owning the sovereign debt of a levered and increasingly more levered counterparty in the U.S. government. So it's a risk. It's been a risk, and the market has. I mean, the Fed was intervening and buying 10-year treasuries, and for a while there, they owned a bunch of them. Now they own less. Rates went up, but not as much as you would have thought. But as we look at the black swans out there, yes, declining dollar, much higher U.S. long-dated interest rates would have a pretty profound effect on the U.S. economy to the negative.
You know, I have very mixed feelings when I look at the credit markets. On the one hand, you know, there were very few Cassandras saying a lot of these incredibly asymmetrical mortgage products were crazy leading up to the global financial crisis. There were very few people warning. And yet now we've had so much talk about leveraged loans and how vulnerable the credit markets are. Everyone from the BIS to Janet Yellen has been saying, oh my God. You know, Tony James wrote an article in the FT saying, actually, Covenant Light gives much more flexibility to companies. It's a good thing, but regulators seem almost hysterical these days. How do you see the credit markets and the vulnerabilities in the credit markets, and where do they come from?
Before I answer that, one thing back on the U.S. long rates. I wouldn't have thought there'd be a huge increase in long U.S. rates unless you had a pretty robust U.S. economy, because I do think the Fed would take action, you know, to intervene again to not drive those rates up. So I think the real black swan moment where you had super high long-term treasuries and a weak U.S. economy is pretty low. As to the leveraged loan market, I think there has been some popular misconception that there's systemic risk related to leveraged loans in the high-yield bond market, and I think that couldn't be further off base. The leveraged loan market and the bond market, which is toward the bottom of the capital structure, proved extremely resilient through the financial crisis. There was lots of talk about widespread capital impairment in that market, and there was virtually none through the financial crisis. Now, there was an aid from the Fed and central banks on lower rates, but the resiliency of the businesses that were financed was quite high. The leveraged loan market today is financed by people who want exposure to leveraged loans. Back in the mortgage crisis, you had deposit-taking institutions owning subprime credit, in effect, at huge scale. That is not the case today. Banks are not buying and holding leveraged loans and high-yield bonds. They are in investment funds. They are in long-dated liability structures like CLOs. And they can withstand a bunch of capital impairment to the extent that were to happen, but I don't believe it will, because you're financing high-quality companies at the top of the capital structure. There's a huge equity component in virtually every larger-scale buyout deal done, as much as 50, 60, 70% of the capital structure in equity. So I think this is going to be – I actually think leveraged loans and high-yield bonds are potentially mispriced, meaning they're the most attractive asset class from a yield perspective relative to the risk that I can see out there anyway.
Can you talk about potential supply-demand imbalances? I know you hate hypothetical situations, but what happens if, for example, GE gets downgraded.
I think,
Well, you know,
I think
many
it's a
people are
problem
talking
for
about
GE,
fallen
but not,
angels, but
yeah.
not for the market.
No, I don't. I don't think the fate of one company will dictate the fate of an entire market.
Yeah. So let's turn to more micro things. I have enjoyed watching you take private equity at Blackstone into some new directions. And I think one of the most important is life sciences. Can you talk about a bit about the Claris deal, what the thesis was, and what the problems were in the capital markets that made you think life sciences is attractive? And even this morning, we saw that Blackstone is doing a new deal, working with yet another traditional pharma company to support research in life sciences that will be, you know, so important going forward.
I think the private capital markets for the funding of life sciences is one of the least well developed in the space. It's not for nothing. You have like 100 buyout guys here and maybe, you know, 2 life sciences oriented investors, probably speaking, over the course of the next couple of days. There's very well established investors on the royalty side at the later stage, more success stage of a drug, and there's a lot of really high quality investors in the venture stage. And in between, supporting the $60+ billion that large pharma spends on R&D, there's very little
This is international.
participation. Yeah, that's international. There's very little participation in the private capital markets to help large pharma fund the enormous increase in innovation that they have neither the capacity nor really the R&D budget to fund themselves. So when we went out to look at how should Blackstone play in this industry.
What made you even think about it?
Well, it's an important industry.
And the capital markets hate big pharma, it seems.
The capital markets don't love big pharma. The biotech IPO markets are quite volatile and really small, to be honest with you. A large biocap IPO would be a few $100 million. And it's also a sector where the end result is you're doing good for patients. You're meeting an unmet medical need. And so we said, geez, that's great. And you know, we don't have hundreds of competitors, playing in that market. And we went around and we met a lot of the people in the industry. We thought about building it ourselves, and we met the guys at Claris. And for the last decade, they've been engaging in formal partnerships with large pharma to take compounds and elements of their R&D pipeline that are either too small or they just don't have the attention or capability or want to allocate the capital to. And Claris comes in really after phase 2 clinical trials, gets the product through phase 3.
And phase 3 is the last stage. That's
the last
human
stage in the
and
US.
the most capital intensive.
Correct. Negotiates with the FDA and has a successful drug that it then either hands back to large pharma for them to commercialize or does it itself. In fact, the deal we announced today with Novartis, which is $250 million, so large scale, takes an entire product where Blackstone will become the owner of the compound in partnership with Novartis. And ultimately, once the drug is developed and successful, and it's for deep vein thrombosis without causing excessive bleeding, either Novartis or another firm will buy it back or we'll commercialize it ourselves. So it's something we could, over time, invest billions of dollars against if it's a successful drug. And the interesting thing about phase 3 clinical trials is that the overall industry has a roughly 60% success rate in getting a drug from phase 3 clinical trial to an FDA approval. So this isn't binary investing, which is another thing we liked. It's not our nature to want to lose money. And so this was the closest to our mental model for investing that we could find. And the Claris team, now the Blackstone team, has operational value add. They have 3 development companies that actually designs the clinical trials, takes over the prosecution of that, negotiates with the FDA or the regulators in Europe, and gains successful approval of the drug. So it's not just pure passive financial investing, it's active operational value add. And while they're not unique, there are very few firms in the world capable of doing what what our team can do. So we're very excited about this, and I think it has overlap with what we're doing in our private equity business. There are entire therapeutic categories that large pharma might want to get out of. You're seeing spinoffs of animal health, you're seeing women's health being de-emphasized, and a combination of our private equity business that can understand and analyze and value and structure a large deal for a mature product portfolio, along with an R&D pipeline that our life sciences team can help us understand and exploit, would be, I think, the type of transaction that really no firm right now is capable of doing, and we hope that we will be able to do that. So I think there's synergy between our private equity business and our life sciences business, and we're really excited about this effort.
To what extent do you think that you will be taking this global as well? It's very interesting to me. Being in Asia, I spend a lot of time with venture capital firms, and if you look at, say, Sequoia, they have a larger life sciences team in China than they do in the US. They think the breakthroughs are going to come from big data, which is all about China. So I wanted to ask you, A, do you see taking this more and more global? And also, do you worry that the US is losing its competitive edge in many ways? It's frightening for me to listen to how all you guys had to kind of educate Washington since the Trump administration started to say something like a Rockefeller University or a National Institute of Health is a crown jewel. You can destroy them a lot more quickly than you can build them up. So are you worried that the US in this world may be losing competitiveness in these leading edge fields that we've all treasured and been so proud of?
I think to answer your questions in reverse, I don't believe the U.S. will lose or is at risk of losing its competitive advantage in drug discovery and deep medical research because the systems, the institutions, the talent is there, the funding in the private sector and for now in the government sector is there. The innovation coming out of the large and extremely well-funded university systems in the United States is extraordinary. The University of California system, obviously Harvard, and that's not gonna be replaced. The bigger issue, and when we were researching this industry, I had the view that, unfounded, that it was harder to get a drug approved in China, and that would be, a more difficult market. And in fact, there's been reform in that country that actually the U.S. is one of the hardest places to get a drug approved, and the standards are extremely high, which is important for safety, but even the government has made reforms to the FDA to fast-track certain drugs. So I think the issue would be one of regulatory intervention more than, I think, funding and talent and whatnot. In terms of Blackstone's ability to engage internationally in the life sciences business, Claris already is an international firm. One of the 3 development companies I spoke about resides in the UK. Most of the drugs that we're funding, have applicability outside of outside of the United States, and we'll continue to build the big pharmas definitionally are global in nature, and we will build the capability, in particular in Asia, to be able to develop and commercialize drugs for the Asian markets, which are quite different.
As long as we're on this subject, let's talk a bit about tech. Mm-hmm. I don't know how many of you were here a few years ago when I was doing an interview with David Rubenstein, and he said at one point, Carlyle was thinking of buying one of the Silicon Valley venture firms. And a lot of private equity people seem to have venture envy, and firms that are doing growth equity, have done more in tech than the firms who you identify with large buyouts. Recently, you hired somebody to get into growth equity. What was the thesis behind that? And can you talk to us about how you see tech investing?
Yeah.
For Blackstone generally?
As I said earlier, Blackstone is not a binary investor. We don't like permanent capital impairment in the portfolio. So that makes it
Rightly, I might add.
to be a venture-oriented investor. It's not our DNA. That being said, we're not going to ignore the real fundamental changes that are happening in the economy, and need to invest in businesses that can grow through a cycle faster than GDP, which we do with roughly 40% of our capital in the buyout fund, investing in growth buyouts. I mean, recently we've announced 2 transactions, which I hope end up happening, that are companies with very high structural growth rates where they're not leveraged buyouts per se. On the growth equity side, the world doesn't need another firm to invest in the 5th or 6th round of Uber and Lyft. But
and there is huge fundraising and growth equity now, far more than buyouts, actually.
But there are thousands of companies out there that at earlier stages in their development that can benefit from the 100 companies we own in our private equity portfolio and the fact that we're the largest owner of commercial real estate in the world. And so as we approach growth equity, it will be, why does Blackstone have a right to improve this business in some way? And what are we bringing that others can't? Again, we don't want to be passive financial investors in anything we do when we're investing in private equity. And so growth will have that same ethos.
We only have 2 or 3 minutes, unfortunately. I just wanted to ask 1 or 2 final questions, given how quickly this period has gone by. And that is, to what extent, how much do you think about, will technology disrupt this business when you're thinking of making an investment? What are the questions that you're asking today that maybe you wouldn't have asked 3 years ago at the investment, committee meetings on Mondays?
I think it's a question we've been asking ourselves since the 90s. I mean, we were investing in wireless communications infrastructure, which were cellular phones, in the mid-90s. And we were looking at payphone businesses. I mean, people bought payphone companies in 1999, believe it or not. And we were sitting there saying, geez, isn't everybody going to have a cell phone? And same thing in yellow page assets.
And you haven't gotten caught the way most firms have in retail.
And
Neiman Marcus, Claire stores, all those disastrous retail investments.
So as an investor, the first thing you ask yourself, is this business going to be around 10 years from now? And what are all the ways it might not? And so that's been part of our investment process and DNA forever. Now, we're not necessarily the early stage investors in wireless technology. We didn't invent CDMA, but we were the guys deploying capital to build out wireless networks in the 90s and cable and broadband internet in the 90s and early 2000s in the US and Europe. I mean, those were investment themes we played at a later stage when we could understand them and the technology was proven. So it's unchanged since I've been 21 years at Blackstone, and we think about it every day. I think the number of companies that can be disrupted and the speed with which that can happen is higher today. So the bar is much higher for us to be right when we're making investment, and to assume it's not going to be dislocated, and we have to think even harder about that every day.
I was going to ask you about some of the risks that you see. How concerned are you about suboptimal policies?
They're giving you the hook, Henny.
Finally, how worried are you about suboptimal policies from Washington in response to the populist pressures that we see today?
The only thing I'd say on that is that the instinct that governments are better allocators of capital and resources than the private sector is not a healthy one for those of us who participate in the private sector. So I'll just leave it with that.
Thank you so much. Thank you. Sorry.
Thank you.